Hey there! If you're gearing up for the SCMP exam, you know fixed overhead variances can feel like a total maze. But don't worry. Today, we're going to give you the map to not just get through it, but to absolutely master it. Let's get right into it. So, picture this. Your boss tells you the factory's costs were way over budget last month. Okay, but why? That's the real question, right? Variance analysis isn't just about spotting a problem, it's about being a cost detective. These formulas are your magnifying glass, helping you find the exact clues to figure out what went wrong. Before we jump into the formulas, let's get our bearings with a really simple idea. We're going to use a case study, a t-shirt printing company we'll call Print Pro Tees. Now, their fixed overheads are those stubborn bills that come in every single month, no matter if they print one t-shirt or 1,000. You know, things like the rent for their workshop and the supervisor's fixed salary. So here's our game plan for today. We're going to start with the big picture, the total variance, and then drill down layer by layer, exactly how you should approach it in the exam. We'll cover the core logic, how to apply it, and then wrap up with some absolutely vital exam notes and a super fast formula recap.
Okay, think of this next part as your diagnostic map. When you're solving a problem, you don't just guess, right? You start at the top and follow the evidence. This structured thinking is exactly what examiners are looking for, and it's your key to a logical, high-scoring answer.
And this table right here, this is our whole journey laid out visually. See how it works? At the very top, we have the total fixed overhead variance. That's our starting point. It splits into two main reasons. Expenditure, did we spend too much on our bills? And volume, did our production level mess things up? Then, volume splits even further. We're going to follow this path exactly. All right, time to start our investigation. The very first step, always, is to figure out the total damage. What's the big number? How far off were we from what we expected? Now, this is the most important business question to ask first. Notice the wording here, what we should have spent for the t-shirts we actually produced. We're not comparing our actual costs to the original plan anymore. We're comparing them to a flexible budget, the standard cost for the actual work we did. This is a critical distinction that can make or break you in the exam. And boom, here's the formula that brings it to life. We take the absorbed fixed overheads and subtract the actual fixed overheads. Now that word absorbed is a key exam term. It's just the amount of fixed cost we apply, or load, onto each t-shirt we make. So the total absorbed overhead is just our standard rate times our actual output. The difference between that and what we actually spent is our total variance. Okay. So we've got our top-level number, but that number doesn't tell us the story. It could be high for two completely different reasons. Now it's time to dig in and find the real culprit. We have to isolate the cause. Was it a spending problem or a production problem? The expenditure variance answers the first question. Do we stick to our budget for bills like rent and salaries? And the volume variance answers the second. Did the number of t-shirts we made cause the issue?
Let's start with the easy one, spending. We've all had that month where the bills were suddenly way higher than we expected, right? That's exactly what the expenditure variance catches. It's the purest look at cost control, and it has absolutely nothing to do with how many t-shirts you made.
And the formula for this, it's honestly as straightforward as it gets. It's just your budgeted fixed overheads minus your actual fixed overheads. If the result is negative, you spent more than you planned. That's an adverse variance. If it's positive, you save some money, and that's a favorable variance. Simple and powerful. So back at Print Pro Tees, what would this look like? Well, an adverse expenditure variance could mean their landlord suddenly hiked the rent. If their budget was, say, $5,000 for fixed costs, but the actual bills came to $5,500, that $500 difference is a pure adverse expenditure variance. It's a spending problem, plain and simple. All right, spending checked. Now for the other side of the coin. Let's investigate how our production volume affected the numbers. This, my friends, is where the analysis starts to get really interesting. So, the volume variance is all about whether we've over or under-absorbed our fixed costs. Think about it. If we produce more t-shirts than we planned, we get to spread that fixed rent over more units, which is a good thing. That's a favorable variance. But if we produce fewer, each t-shirt has to carry more of that fixed cost burden, which is adverse. So, the formula for that looks like this. It compares the overheads we absorbed based on our actual output against the overheads we had in our original budget. But here's the thing. This formula only tells us that our volume was different. It doesn't tell us why. For that, we have to go one level deeper. So why was our production volume different?
Well, it almost always boils down to two things. First, were we efficient? Did our team work faster or slower than the standard? And second, did we use our capacity? Did we actually run the factory for as many hours as we planned to? Let's break those down.
This is all about efficiency. The key question here is, for the hours our team actually worked, did they produce the number of t-shirts they were supposed to based on our standard rate? Forget the budget for a second. This is purely about performance during the hours on the clock.
Okay, so the formula basically asks, how many hours should it have taken to make this many t-shirts, and compares that to the hours we actually took. If the standard hours are higher, it means our team was super efficient. They beat the clock. That's a favorable variance. If the actual hours were higher, they were slower, and that's adverse.
Okay, last piece of the puzzle, capacity. This is my favorite one. Imagine you bought a gym membership and planned to go 20 times this month. This variance doesn't care how hard you worked out. It only asks one thing. Did you show up 20 times? It's purely about using the time you had available.
And the formula reflects that perfectly. It just compares the hours you actually worked against the hours you budgeted to work. Working more hours than budgeted is favorable because you're utilizing your assets more. Working fewer hours is adverse because your expensive factory was sitting idle when it should have been running.
Okay, deep breath. We've gone through all the logic, but for the SCMP exam, logic is only half the battle. Now we need the pro tips, the tiny details and common traps that separate a good answer from a great one. You'll want to pay very close attention here.
Look, examiners are picky about terminology for a reason. Precision matters. You absolutely must know the difference between absorbed overheads and budgeted overheads. It's not optional. My advice? Screenshot this slide, make flashcards, do whatever you have to do to know these definitions cold.
And listen up, because this next point is a classic exam trap that catches so many students. Unless the question explicitly tells you otherwise, all these variance calculations are based on productive hours, the hours worked. Idle time? You ignore it. Remembering this one simple rule could honestly save you a ton of marks.
All right, we've covered a ton of ground. To make sure it all sticks, let's do a super quick formula flash recap. I'm just going to show you the formula on the screen, and we'll call out its name and purpose. Ready? Let's go.
Total variance, the overall difference between absorbed and actual costs.
Expenditure variance, the pure spending check, budget versus actual.
Volume variance, the impact of producing more or less than planned.
Efficiency variance. Were we faster or slower than the standard?
And capacity variance. Did we use our factory as much as we planned to?
And that's it. You now have the complete diagnostic toolkit for fixed overheads. But remember, getting the right number is only step one. The real skill, the reason this is on your exam, is using this information to ask smarter questions and make better decisions. Now you know why costs changed. The real question is, what are you going to do about it? Good luck.